Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
Oh man, I am doing awesome. How are you?
I am doing fantastic. Always a pleasure to see you.
Yeah, same here.
Thank you. And Judd, how are you this morning?
I'm fantastic. I'm ready to get a chance to let the viewers out there know the 4 things they need to do before the end of the year when it comes to taxes and investments.
Absolutely, and it's such a timely show that we have this morning because obviously, as you mentioned, we are planning for the end of the year, and boy, what a year it's been, right? It's
unbelievable.
Been unprecedented. So before we get into the taxes, I just want to talk a little bit. How's life been in the office, Stewart? How busy have you been?
Well, it's been unbelievably busy. I think the message we have for our people is just completely resonating. People realize that they have a choice when it comes to planning and advisory services. And I think that we've just really resonated with them in a different way than other people have. So.
Absolutely, absolutely. Judd, let me ask you, because so often people may think of maybe a tax professional being a separate entity, if you will, versus financial planning. The decision to merge these together, where did that come from?
It's always kind of been the philosophy of our company where we want the left hand to know what the right hand's doing. So we've tried to build something where obviously taxes are an integral part of any financial plan, regardless of age even. And then as you get into more sophisticated investments, larger investments, obviously taxes become a much bigger piece. So rather than some of the advisors out there that either can't talk about it or just choose not to talk about it, we've really made it a cornerstone of our practice.
And I think it makes perfect sense. Obviously, that becomes a one-stop shop, if you will, is what I'm trying to say, which is perfect for people. I was going to say one size fits all, but that's not. It's one-stop shopping.
Absolutely.
So, Stewart, I want to ask you, obviously, there are 4 things that we need to be doing right now to prepare for taxes. Let's talk about the first one, a thorough tax review. How do you conduct a thorough tax review with your clients?
Well, I think it's really important to look at what's available for each client, meaning, what options they have available. Here's an example. We have a client that did some of his own investing for years, loved the guy to death, but he sustained some losses in his portfolio, some long-term capital losses, and he's had several $100,000 in long-term capital losses. Well, he's very conscientious when it comes to taxes and how much he's paying. So what we did was we actually created a strategy, a growth strategy, where normally you would choose an income strategy, but for him we chose a growth strategy to harvest his long-term gains against the hundreds of thousands of dollars of losses that he has. So basically he's paying no taxes, yet this year he's absolutely annihilated the market and he'll be tax-free, at least on the investment portion of what he has. So that's
fantastic. So tax-free. That's amazing when you think about it like that.
Well,
I'm sure he was really happy.
Well, remember, let's be honest. He's harvesting against losses that he took in previous times. Because remember, when it comes to capital losses, you can harvest your capital losses against capital gains, dollar for dollar. But once you're out of capital gains, you can only deduct, $3,000 a year against ordinary income. So people end up carrying these carry forward losses, until they're gone, until they die, because they don't know how to harvest it properly. So I think what we do really well is look at every avenue to be efficient. And with that kind of situation, we can take much less risk because we're so much more tax efficient.
Absolutely. Judd, let me ask you a question. When people are calling in and they're asking you about the thorough tax review, what do you ask them to bring with them to the meeting, if you will?
Well, so for the most part, obviously, if we're talking about taxes, we're going to want you to bring your previous 2 years' taxes, unless something is going to dramatically change going into next year. But otherwise, that way we can get an idea of what your consistent income is. As Stewart likes to say lots of times, any irrevocable income streams, if you happen to be someone who's already got a pension, or if you're beyond RMD age, so you have to take those amounts each year, then we want to be able to see what's going on. At the same time, as Stewart mentioned, when it comes to doing some of those harvesting, obviously bringing in your investments so we know what type of gains you have in there is always going to be something as well.
Okay. Stewart, does that count as rental property income as well? Is that something that you would look at with the total tax picture?
Oh, 100%.
Yeah.
So like, we've said in previous episodes, the whole reason for our tax office it's not just about tax preparation, right? Because we have clients that'll watch a show and they'll say, you know what, these guys are great, but you know what, we do our own taxes. That's fine. We don't, the tax center isn't a profit center for us.
Right.
It's to help us plan better for our clients. And so if somebody does their own taxes and wants to continue doing it, God bless them, awesome. We just take that final return, right? We look for inefficiencies, kind of give them a heads up as to what we believe we can help with. But we take that information, plug it into our software, and we can now plan. It's just about having the data. Whether they do it themselves or we do it, doesn't matter to us.
Okay.
We like doing it because we know that it's a more professionally prepared return. But it's we're completely okay with people doing their own taxes, bringing us the final results, and let us pick it apart.
Okay. Judd, in your opinion, how important is it to have tax planning be a part of the overall financial plan, if you will?
Well, I think the older you get, the more integral it becomes. And as we've talked about on some of the other episodes, when it comes to Social Security, RMD, pensions, how you take your money out in retirement, taxes are going to be the cornerstone of that, because you're going to get into that spot where you now have this income, there's no way to get around it, and if you haven't done proper tax planning up to that point, you could run into a scenario where you're paying higher taxes in retirement, or a situation where when one of you passes away, the surviving spouse is actually pushed into a higher tax bracket.
Okay. Stewart, let me ask you also, we hear so many talks right now about a Roth conversion. Is that a strategy that you would use to help someone with taxes?
Well, so Roth conversion isn't going to help you immediately, but it helps you for the long term, for sure. And what we do, first of all, Roth is not appropriate for everybody, but it's appropriate for most. And the reason I say that is everybody knows Roth is better than non-Roth, right? Like, it's very clear, hey, it's better to let it grow forever, never pay taxes on the gains, etc. But the question is, at what pace should you be, converting to Roth? And a lot of people think, oh, I can only convert $7,000 a year, whatever their contribution threshold is. What we want to help people understand is that there's two very distinct differences when it comes to Roth. There is contribution and there's conversion. Those are two separate things. There are no limits to conversion dollars. But the question is, what if you start passing certain tax thresholds? There are implications for that, right? Like when you pass, $170,000 or so, there's implications for IRMA, for Medicare penalties, et cetera. And you just have to know where all of those stumbling blocks are along the way. And remember, all we can do is present the outcome, the effects of doing it. And you guys are all adults. You can decide on whether it's right or wrong for you. And if you decide to take our advice, because we have a lot of clients that will just say, forget it. I don't want to pay the taxes.
Yeah.
But it's really important to understand that right now, right, at least for the next year, we believe we are in the most efficient tax window in history. If you don't take advantage of that plan in this window, it's your fault.
Yeah.
Don't ever, everyone looks back at the old Roth conversion days when we had this really advantageous, window. People are like, I wish we would have done it. Well, you know what? We're kind of in a similar window now where most people believe tax rates are going up. Somebody has to pay for all the stimulus, right? And yes, stimulus was needed. That's why we had that V-shaped recovery.
Sure.
But remember, we don't know what the future holds. We have a huge discount going on right now. Going into the holidays, just think of it. There's a fire sale going on right now, right?
Exactly. Yeah.
Let's go shopping for taxes.
Absolutely. It makes perfect sense, Stewart. Well, I love listening to both of you each week, and I'm so excited about our show. Obviously, this is such an important topic, taxes, but I want to let the viewing audience get to know you both on a more intimate level. So we are going to play a video just watching you day to day in the office, if you will. But before we do that, Stewart, I'd like to just go ahead and give you the opportunity to tell the viewers what they can call in and expect to receive today by the offer as well.
Sure. Well, today what we're doing is offering a complimentary portfolio review. In that portfolio review, if you decide to bring in your tax returns as well, we'll take a look at any sort of inefficiencies. We'll have our tax people take a look at it and see if there's any sort of missing items that you're concerned about, any sort of efficiencies that we can create in the future, for your future.
Stewart, thank you. Judd, thank you. To the viewing audience at home, the phone lines are now open. That number to call is 833-652-7829. We know you have a lot of questions about how to plan for your retirement and maybe need a little assistance with your taxes. Stewart and Judd are able to provide those answers for you. We're going to play a very short video, but when we come back, we're going to have more questions and answers with how you can plan your perfect retirement. Please stay tuned.
What happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. You know, I think it brings a smile to their face.
We get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, you know what, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Gentlemen, I love that video about the two of you and just your day-to-day experiences in the office, if you will, because the feedback from the viewing audience has been just so overwhelmingly amazing, and they're so excited to meet you when they come into the office. They say that you're exactly the same as what you appear on TV. So I love being able to play that video so they can really get to know you in case they're tuning in for the very first time today.
Yeah, no, it's, honestly, that's one of the coolest things about our TV show is that when I walk into the room and they're like, oh, it's really you meeting with us.
Yeah.
It is. We're not passing off to some junior advisor. If people call in and they ask for our help, we're going to be there to help them. And it's going to be Judd and I and nobody else. And, we're going to be the ones there to help. And so, no, it's actually one of the really cool things.
It really is. And it's such a blessing because not only are you an independent, but you're also a fiduciary. So putting those two things together, people coming in realize that you're putting their best interest first. Above anything else, they come first. And that's a gift that you give your clients.
Yeah, I mean, I think, Judd kind of started off the fiduciary part of our business years ago, and we were way ahead of the curve. It's completely changed the way we approach things. But the one thing, when you're doing your end of year planning, the first thing to do is my advisor a fiduciary? And one of the really key ways to kind of look and find out, is he a fiduciary? You pick up your statements, look at your statements, and when you start seeing mutual funds in there and you see loads, A, B, C, D, E after the title, those letters usually indicate a load. If you see those letters, you need to call us. You need to call in and say, hey, let's get this checked out. That's usually the first sign that somebody's... Now, you could still be a fiduciary and have those, but those typically are paying some sort of back-end fee to the advisor that we just aren't allowed to collect. And we don't want to collect them. Because whenever we call our clients, we want them to know that we're calling to help. We're not just calling to sell them something.
Okay, excellent. And that's what I just adore about both of you, because you're just amazing at what you do. So with this part of the show, guys, we've had some viewer questions actually that have been piling up. So I hope you don't mind, because I'd like to take some time today to actually address the viewer questions. They've been so patiently waiting for some answers. So Judd, I'm going to toss the first one to you if that's okay.
Absolutely.
And you have no idea what's coming, but here we go. It says, Judd, I recently inherited an IRA from my mother who passed away earlier this year. It is a sizable amount, and I am worried about the taxes. What should I do? I enjoy your show each week.
Oh, well, thank you very much for watching. We appreciate that. Very sorry about your loss. However, I guess if there is a silver lining here, because it was an IRA, it's a scenario where the money's not going to be taxed as you inherit it. So because of that, you don't have to worry about the taxes immediately today. The catch is, last year they passed what's called the Secure Act. And what that did is, since this is an IRA that's not inherited from a spouse, which allows you to be able to carry it on for the rest of your life, in this case, a non-spouse beneficiary, you will have to take the money out of this account and pay taxes on it, but you need to do that over the next 10 years. So kind of coming back to the planning and things that we talk about, is that, does it make sense to wait and take it out later, but before the end of the 10 years when you're within a lower tax bracket, or does it make sense to start taking it out now? So that's a great question. Again, you should be looking at that, but there's no immediate tax consequences today.
Okay, excellent. Thank you so much. Stewart, this next question is directed at you. It says, Stewart, my husband recently passed away, and I would like to gift a portion of his 401k to our kids and grandkids. Is this a good idea so they can pay taxes instead of me?
So the answer is generally no, unless structure was set up ahead of time. Now, obviously, you know, hindsight's 20/20, right? But if you guys have intentions of passing assets to the kids directly and avoiding a spouse, there's certain things that you should do. Now, in this case here, the question is, or the answer is, it all depends. If the spouse is the beneficiary, the surviving spouse, so let's say the gentleman passes away, the wife survives, and she's the primary beneficiary on everything, and she decides to gift these assets out. Well, there's two tax issues that are concerned, or that are concerned to me. Number one, the assets or the taxes aren't divided amongst each other because she's the one receiving the benefit. So what ends up happening is they end up, you know, having to pay this super high income tax rate. Let's hypothetically, for easy math, say that it was $1 million. And she wanted to give $100,000 to each of the kids, and there's 4 kids. Well, for each of those kids that she's taking an extra $100,000 out, that is just bumping up her tax rate. So there's that issue, right? Then there's also gifting issues, which I know Judd wanted to talk about, you know, later here. But gifting is a huge issue too. There are gift tax returns and so forth. There are more efficient ways. That is why it's so important to have a plan. You know, like Mark Henry says, you know, get off the couch and make a call and make a plan. It's really, really important to make sure that you outline the game plan so that you know where you're going. We always like to tell our clients that, you know, you need to know all the contingencies. If something happens to, you know, the man, if something happens to the woman, what happens in each of those situations? We game plan those out all the way down the road so that the outcome is predictable, right?
Absolutely.
And Judd jokingly calls me the man of leisure, but it's true. Like, I don't want to do the amount of work that if we can do 2 hours of work up front to save 20 hours of work on the back, let's just get it done.
Absolutely. It makes total sense. I agree. Well, Judd, it's time for us to open up the phone lines to the viewing audience once again. Can you tell them what they can expect to receive by calling in today?
Yeah, absolutely. If you give us a call at 833-652-7829, we're offering a complimentary portfolio review and analysis at our office. Again, it's complimentary. Leave your checkbook at home. The idea is you bring in with us what you want us to cover for you, taxes, investments. We'll go through and run the analysis and make sure that you're in a good spot. It's one of those things where we kind of joke that, you know, whether you're thinking about it or you need a second opinion, the reality is that you're not turning everything over to us day one when you walk through the door. The idea is you're going to come in, we're going to get a chance to meet, see if there's a good fit there, see if you need any of the services that we offer. It may even take more than one meeting to get those questions answered. And again, there's no cost or catch with that. But if you call 833-652-7829, we look forward to a chance to sit down with you.
Judd, thank you so much. Stewart, thank you so much. To the viewing audience at home, as Judd mentioned, the phone lines are now open. That number to call is 833-652-7829. If you have questions about how to plan your perfect retirement, or perhaps questions on your taxes, the gentleman here can help you. The number to call is 833-652-7829. We'll be right back after this very short commercial break.
This is the story of how you get from here to there. Right now you're here. But in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Gentlemen, a great show that we're having today, obviously talking about the importance of tax planning. We had some viewer questions mixed in. I think we have some more to come in our last segment today. But actually, Stewart alluded to something that I wanted to ask you a little bit more about, Judd. I wanted to ask you about annual gifting and lifetime gifting options. Can you explain that a little bit more, since Stewart did touch on it a tad?
I sure can. Basically, he alluded to our number 3 on the 4 things you need to do before the end of the year relating to taxes and investments. And just quickly, before I get into that exact answer, you know, people out there, if you're just tuning in, you might wonder, well, why would I want to listen to these guys? So we have a full service tax practice. We've got 23 years under our belt in business. We have a full team of enrolled agents, CPA, certified tax preparers, and we use a very robust Thomson Reuters tax software to go along with that experience. So again, as we talk about these things, you know, we know what we're doing. So the number 3 thing that you need to look at is going to be annual gifting and lifetime gifting options. Now here's the catch, is basically each year you are allowed to gift up to $15,000 to anybody you want to. And you don't have to report that you're giving it to them. They don't have to report that they got it. But of course, you don't get a tax deduction with that as well. The other piece is that we all have what's called a lifetime exemption. And that lifetime exemption is something where right now it currently stands at well over $11 million per person. So a lot of people aren't going to get to that level. But with some of the changes that are coming up in administration and potentially taxes over the next couple of years, what we know right now is that that's good through the next, 2021 at least. So the idea is you're able to gift up to that $11 million to anybody that you want, but you do have to document that on your tax return, showing them that you're using up part of your future dollar amount. And again, so it's one of those things where you want to be able to take advantage of what they do give us in the tax code.
Sure, absolutely. So again, it all ties into end of year planning and proper tax strategies, if you will.
Absolutely.
So Stewart, our last topic, obviously the 4th thing to talk about as far as tax planning, actually comes in the form of a question from a viewer. It says, Stewart, I've heard that Roth conversions are a good idea. What do you recommend for me? That is a great question. But
Right, yeah, well, it all depends. I mean, like we talked about earlier, when it comes to Roth conversions, it all depends on your situation. The way I would explain it best is to say that Roth makes sense for people if their financial situation is going to lead them to a higher tax bracket later. Now, most people put away all this money in 401ks and they create this massive tax time bomb, right? And I can tell you, the reason that 401ks in the normal pre-tax, situation aren't efficient are, number one, it ends up making a lot of your other stuff more taxable when you're retired. So Social Security for a couple will receive between $900,000 and $1.4 million over their lifetime. Now, for some people, that's their biggest asset. So wouldn't you much rather not pay taxes on Social Security? Well, if you have big pensions and so forth, well, that may not be a choice. But for some people that don't have these irrevocable income streams that Judd was alluding to earlier, there are some really important efficiencies that you can plan for, and just make sure that it's not just about what you make, it's about what you keep. And it's not just about paying taxes on the underlying investment. It's about how that underlying investment and tax consequence affects everything else down the road. And so I think it is important to plan. When it comes to diffusing that tax time bomb, I think it's really important to also game plan it out, not just for this year, right?
Exactly.
And in one of the previous shows, I talked about a client of ours, had about $7 million.
Yeah.
And the reality is that our plan for him said that let's roll over this $2 million $2 million IRA, convert it all to Roth over the next year or 2 years. Both worked out the same. And his CPA thought we were morons on the surface. Well, it's an understandable response because they're looking at him paying 37% tax. Who the heck wants to pay the highest tax bracket?
Right.
Well, what we showed him was he was going to be at 37% tax no matter what. So why not do it in this discounted environment and make other things substantially less taxable? So the answer is, it all depends. That's why you need to have a plan. That's why it's really, really important to have a plan. And for people who have over $250,000 in these plans, it's crucial to plan.
And we've talked about this in the past, that hope is not a plan. You can't hope for the best. You have to plan for your future, and you need to make sure that your retirement years are stress-free. And what's amazing is that you are both so able to customize a plan for each individual that comes into your office with just having the ears to listen, and you genuinely care about your clients.
Absolutely.
So again, retirement is not one size fits all. It's very customizable. So gentlemen, thank you so much for another great show this week. I know the viewers have loved it. To the viewers at home, thank you for spending time with us again this week. That number to call is 833-652-7829. If you have questions about taxes, retirement, or how you can just plan for the stress-free years of your life in retirement, they have the answers for you. Thank you again for watching. Be safe, be happy, be blessed. We look forward to seeing you back next week. Keep those questions coming. Thank you.